Hello, everybody, and welcome to the show today. I'm really excited you could join us. So today is a really cool day because I have a buddy of mine on the show to go through some really cool funding options for you. So if you're looking to start a business, looking for funding for a startup, or if you're looking to get funding for your business a really fast, easy way that's no doc without all the tax returns and bank statements, that's exactly what we're going to be talking about today. And if you're a loan broker, you're going to learn about an amazing program to be able to offer to your customers where they can benefit from getting financing with no doc and as a startup as well. So with us today is Roy Ferman. Now, Roy is considered a foremost expert on the subject of business funding, specifically startup business funding. With over 20 years of entrepreneurial experience, Roy has built his career helping business owners launch and scale their businesses. He currently serves as the CEO of Seek Capital. Having recognized the void in the lending industry for entrepreneurs, Roy founded Seek with the sole purpose of helping startups and early stage business owners access the capital they need to launch their businesses. Now, Roy's a weekend warrior ranging from rock climbing, basketball, and running. An avid traveler, Roy can usually be found planning out his next trip. Roy spends his time with his wife and two beautiful daughters, continuously exploring Los Angeles and surrounding cities. Roy, welcome. Thanks for coming to the show.
Thank you for having me.
Well, we spent a lot of time together, man, and I'm really excited you could be here because the bio says it. You fill the void. I mean, the biggest problem out there, as we both know, is that startups and people that can't prove income with bank statements and tax returns really struggle to get money. So what are you guys doing out there right now to help solve that problem?
Yeah, so what we did is we kind of looked at it, and we were working in the business funding space, and we recognized that all these lenders that we were working with, they all wanted business owners who'd been in business for 1 year or business for 2 years. They wanted folks who had annual revenue of $100,000, $200,000, but there was really nobody catering to the guy who just wanted to start a business. And so what we see, the majority of the business owners that we provide funding to, I would say 8 out of 10 of them actually still work a day job, and they're running their business in the evening and the weekends, and they're ready to go full time and take it full on. They need a bit of money. They may want a mechanic who's working out of a garage at his home. He wants to go and rent a space, or it could be someone who's baking cookies, that kind of thing. They're ready to go and take the plunge and get a proper premises out of their home. And that's what we help so much. And so when we look at it, we go, all right, how can we get these folks funding? And so we started doing a little bit of research. And what we realized was, hey, if you have good credit, we all know it, good credit opens options. And there's a lot of options in the consumer space, but not a lot of options in the business funding space. So we started going, what options are there? And we started realizing, hey, some people can take out a home equity line of credit. Hey, not everyone really wants to put up their home as collateral, right? And then you can liquidate your 401k. And that's great for some people, but not everyone has a 401k. Or some people don't even have the right type of 401k to facilitate that. But it is a good option for some folks. And so what we realize is, hey, when we look at the banks, right, those are the biggest lenders in the country, whether it be consumer or business. There's just so much volume going through them. And so we started talking with the banks. We started doing a little bit of research, and we looked at and we narrowed in on one thing and one thing only. We're a one-trick pony. We've been doing this for 4 years now, and all we do for our customers, or all we do, is we get them unsecured credit cards that have line of credit capability. And everything we do for our customers always going to be 0% interest for the first 12 to 18 months. So as you can imagine, we speak to a business owner starting their business. We say, hey, we can get you money at 0% for the first year. They're like, wait, what? And we're like, yeah, that's it. It's going to be 0% for the first 12 to 18 months. And that's what makes them so excited. So here's our process, Ty. It's really simple, right? We do a soft credit pull. We're licensed with the 3 credit bureaus directly, okay? So we do that soft credit pull, and we understand who we're talking with. And we can only provide funding to folks who have good personal credit, right? The banks take this really simple approach, right? It's very, very common sense. If you're good at managing your personal finances, there's a good chance you'll be good at managing your business finances. If you've got your credit's not very good, what you're saying to a bank is, hey, I haven't been able to manage my personal finances. And they're not going to feel comfortable lending you money for your business, right? So every one of our customers has to have a 680 plus credit score. Obviously, the higher, the better, okay? Our funding ranges from $10,000 up to $150,000. If there are co-signers or a husband-wife type situation, then we can go up to like $250,000, even $300,000. But the average is right around that $50,000 mark. And so what we do that soft credit pull, we evaluate their credit profile, and we've got enough historical data. We've evaluated and underwritten a little over $250 million of approvals. So we've got a pretty good data set. right? And so our algorithm then matches them to which banks are going to approve them and for how much. So let's say Bank of America as an example. They've got 12 different credit cards, right? You don't know which one is going to approve you and which one is not, and how much they're going to approve you. And that's what our algorithm does, right? So it matches the user to the right one. So the first thing we're going to do, underwrite the profile. And next is we're going to match them to multiple credit cards based on their credit profile versus how much money they're looking for. So if someone comes to us looking for $50,000, there is no single bank on the planet who's just going to give $50,000 to a brand new business, right? No big deal. We'll get, let's say, 20 from bank number 1, 15 from bank number 2, 10,000 from bank number 3, another 5,000 from bank number 4. And so we get them $50,000 combined from multiple banks, okay? And that's really how we do it. Then the next thing we do is we actually give them the ability to make payments from their credit card account to vendors that don't normally accept credit card, right? Some of our clients are like, hey man, all my vendors accept credit cards. We're easy, right? It's it's online media, whatever. The others are like, hey, I got to pay rent. They don't accept credit card. I got to make payroll. I got to pay my staff. They don't accept credit card. So we actually give our clients the ability to make payment to their vendors from the credit card. They can write a check. They can send a wire. We help them with that ability, right? And that's what we do for our clients. Does that make sense, Ty?
Yeah, it makes a lot of sense, and I've taken a lot of notes and have a lot of questions, if you don't mind.
Yeah, please.
You said credit cards with cash out capability. You said
Yes.
0%. But what you and I know about credit cards, that doesn't really exist in the normal world, right? You either get the benefit of credit cards with 0% or the benefit of credit lines where you take cash out without paying exorbitant 20% fees. So it's almost like you're describing a hybrid program that doesn't even really typically exist in the normal space that business owners can access.
Yeah, so look, and you're right. We've been working with the banks for 4 years now. We have a pretty good understanding. That said, the banks are always changing. There's always something new. There's always a new program coming in and a great program going out. So we've got to keep abreast. We've got to keep communicating with the banks and knowing what's going on there. But yeah, the short answer is, look, we don't want our customers to ever use a cash advance, right? Those are going to cost 23, 25, 28%, right? Now, some people, they really need it and they're going to do it, but we don't want that. We say, hey, we're going to get you this money. It's going to maintain the 0% interest rate, right? And that's how we do it from the credit card account.
Sure, which is, as a startup or somebody in that phase is perfect because you can't get lower than 0. So you're getting up to 150 grand without paying interest to keep payments low at a time where we both know businesses really need it, which again is the opposite of normal way of thinking, right? Typically, we see lenders in these higher risk situations charge way more interest. And then the problem is, even if they can qualify, it's pretty tough for them to even afford the payments to be able to get the financing.
Yeah, and not to knock the MCA guys, we work with a lot of them, and it's a great product for the right people. But if you ask the customer base there, what are the two largest frustrations? Number one is the rate, and number two is the amount of money they get, right? So those guys just can't get enough money, and that's really one of the problems that we're trying to solve for, is getting them enough money at a good rate where they can afford the payments. Here's the great thing about the line of credit with credit cards, right? Your payment, your monthly minimum payment is generally going to be 2% of the outstanding balance. So that basically means for every $10,000 that you borrow, you're only going to have to pay $200 a month. Not bad.
No, and that's what's nice about revolving too, is that you're only paying on what you're using versus having a loan where you've got to sit there and have this hefty payment on money that you're not even typically using.
Correct, exactly. And that's a beautiful thing. We'll get someone, let's say $70,000, and they have $20,000 of expenses up front, right? But they still have that other $50,000 waiting for them, but they don't have to pay for it. And that's the beauty. To give someone who's got some inventory, or hey, they want to hire some staff before the holiday season, or they know they've got some expenses coming up in the future, we can get them that money today. It's there waiting for them, but they don't pay for it until they actually use it.
Cool. Makes sense. The other thing that you'd mentioned was 10 to 150,000. Roy, what kind of factors kind of determines that? How can somebody get an idea off the top of their head of what they may qualify for? Of course, I want to talk about how they can get an official offer, but how does it determine if somebody's going to get the 10 or the 150?
So obviously credit profile there's a credit score, right? That's a great leading indicator. But then we say, hey, we're going to look under the hood. What are the factors on a credit score? So banks in America, really simple. They want to see, or all lenders, right? They want to see that someone has lent you money before, you've used that money, and you've paid it back. So you've been responsible with your money, right? So we get the 22, 23-year-old kid. He's like, oh, I've got a 730 credit FICO score, right? But when we look under the hood, he's got 2 credit cards and one of them's on his mum's name, right? That's not the same as a 730 on a guy who's 42 years old, had a couple of mortgages, car payments, credit cards, store cards, student loans, etc. Does that make sense, Ty?
Yeah, makes perfect sense.
Yeah, so we really want to look under the hood. And what we're looking for is responsible use of past credit, right? So first thing we're going to look at is, have they had revolving credit lines before? Have they had credit cards, store credit cards, right? We're going to look and go, hey, we want to see at least a one card of $3,000 limit or more. That's the minimum to get in the game. Obviously, the higher, the better. Look, if you're a bank and you're going to lend money and you have one guy who's managed $3,000 and another guy who's managed $20,000 limits before, you know which one you want to lend money to again, right? Simple as that. So the higher, the better. But at a minimum, we want to see a minimum of $3,000. We want to know that he's had that card for at least 36 months, okay? And we want to see at least 7 or 8 trade lines on his credit profile, and non-student loans, by the way, okay? Those are different, right? But we want to see, has he had some credit cards? Has he had some store credit cards? Has he had a auto financing, okay? All these different factors and more, right? But we want to see there's some depth there. Does that make sense?
Yeah, the depth of the credit profile helps determine how much money somebody's going to get. Makes perfect sense. What if, entrepreneurs sometimes have risky credit because they have bumps because they're risk takers, right? But like, for example, I might have bumps on my credit, which I have had in the past, but well past that. But my wife, she's sitting high on the horse, right? Because she doesn't take those risks. So is it possible if I'm an entrepreneur and I've got some dings on my credit to bring in a spouse or somebody else to actually help me qualify versus me trying to when I don't have the credit to do so?
Yeah, absolutely. And actually, we see that to be a significant part of our business, right? And the analogy that we always give is like, hey, imagine you just left college and you're about to sign your first apartment lease, right? And they go, yeah, we need your parents to sign. And effectively, that's what it is. It's a co-signer environment. So if you didn't pay, your mum or your dad would actually would be responsible for it. So in that situation, yeah, we have a lot of spouses, husband, wife, boyfriend, girlfriend. We have a lot of parents who help out. We even have a lot of business partners who come in, right? So business partner number 1, who is the person who inquired with us, they may not have sufficient credit, but when we start having a conversation with them, turns out their business partner does have good credit and they're going to be the person, okay?
Sure. So it sounds like you can then use somebody else as a guarantor to qualify even if you don't have the credit. So it's even another alternative. What about collateral? What about cash flow? I mean, you and I both know that it usually takes those. It usually takes a 401k or account receivables or the income. You're saying that you can get $10,000 to $150,000 without any of the cash flow or any of the collateral that's required with almost all other kinds of business financing?
Correct. Yeah. So you've got collateral-based funding, which could be like a home equity line of credit or equipment leasing, those kind of things. They all have their place in the market. But no, the funding that we do, when we get someone $100,000, $150,000, no, there's not going to be any collateral required. And one of the great things for these new businesses, and this is really what we focus in, we're not even looking at the cash flow, right? One thing we do want to see is that they do have an annual household income, right? They want to have some income coming into the home, right? That they can actually make payments. But look, if you're borrowing for every $10,000 that you're taking out, it's only costing you $200 a month, right? Very, very manageable, right?
So, right. Makes sense. Roy, the other thing you mentioned along the way is you mentioned the word soft pulls. There's people that are listening that don't know what that is and don't know why it even matters. So can you talk about the impact of inquiries in the business funding space, the value of what not having them means, and what is a soft pull?
Yeah, so before we define a hard pull, let's look at what before we look at a soft pull, let's look at what a hard pull is. So a hard pull is a creditor, someone who's looking to extend you credit, does a credit inquiry to review your credit profile. So a lot of times, even if you're getting a phone from Verizon or T-Mobile or AT&T, whoever, right? They're going to check your credit to see that your credit worthiness. Are you somebody who pays your bills on time? That's what they're looking for. So a bunch of years ago, I don't know the exact, probably about 10 years ago or so, the credit bureaus got together and they created what is called a pre-qualification, otherwise known as a soft credit pull. And And what that is, it gives a creditor or a lender the ability to see the credit profile, but it's not a inquiry. So it doesn't show anyone else that they did that credit pull. Now you ask, okay, how does this play in? Why is this option even available? So what happened is when the creation of the internet brought a whole new slew of different business models, and you had these aggregator business models, right? So someone's going on looking for a mortgage or looking for auto financing. The website itself can do a soft credit pull and say, all right, we're going to match you to these 3 lenders. Now, if they like you and they want to extend credit, they're actually going to do a hard credit pull. But just for us to match you, we're not going to do a pull, right? And so that's it's called a pre-qualification pull, or otherwise known as a soft pull. That's what it was created for. So when someone comes to us, we're not going to do a hard pull. Seed Capital doesn't do that hard pull today, right? We just do the soft pull today. Then when we refer the customer to the bank, obviously the bank is going to do their own hard credit pull, their own inquiry, right? But yeah, when you look at various credit pulls on a credit report, certain banks and lenders are going to have hard and fast rules. If you have too many, you're automatically declined. So as an example, if someone came to us with, let's say they had 12 credit pulls on their profile in the last 6 months, we are going to automatically decline that person. Okay? The banks just will not accept it. It's not our choice. We just know what the banks are looking for. Okay? What we're really looking for over the 6 months, we're looking for less than 8. 8 is really the hard max for us. Now, what people don't realize is that different credit pulls actually have different weight. So a lender is going to look very differently at, you applied for a mortgage versus you applied for a personal loan versus you applied for a new iPhone, right? The iPhone at the AT&T store, not going to carry a huge amount of weight. If you're looking for a mortgage, you're taking on some debt there. Does that make sense?
Sure. Yeah. The more absolutely, especially through major banks. If
Correct.
you got an inquiry from Bank of America, it's completely different than Verizon.
Exactly.
Right.
Yeah, and there's different coding in the back end, and that's able to be analyzed by any creditor.
Now, what if somebody comes to you and they have 8 inquiries, as you said, but then when they look at the credit report, they're surprised they don't even recognize 3 or 4 of them? Do you guys have an outlet where you can refer them to somebody to help in that scenario?
Yeah, so there's 2 different avenues that we'll do for what we wouldn't call it credit repair. We'll call it just credit guidance, if you will. We'll have a ton of people come, you've got a $71 collection from Verizon, right? And they're like, what the hell? They didn't even know it existed. And so what happened was they moved apartment or moved home, 6 months, a year ago, a year and a half ago. They missed their last bill for Verizon for their Fios or whatever, and they didn't even know about it. And so we basically will provide them some guidance. It's not credit repair or anything like that. We're like, hey, you've got to pay that. Here's the number to call. You've got to pay it off, and you've got to we'll get a letter from the creditor, and we'll have that submitted to the credit bureaus to have it removed from your credit profile. Okay. And so we do a lot of that, right? Just helping the client.
Sure.
Yeah.
What about utilization? Does utilization rates on credit cards that they already have make a difference for approval?
Yeah. So this is one thing that a lot of people don't know, and they get themselves into a little trap. So perfect example, I went to Home Depot the other day, Black Friday, wanted to buy some stuff for the house. And they said, hey, do you want to get a 0% credit card, finance that stuff over 24 months, right? Sounds like a great deal. But here's the problem. If you go ahead and you want to buy $5,000 worth of product from Home Depot, they give you a $5,000 credit card paid off over 24 months. Sounds great. The problem is now you're showing $5,000 in debt, $5,000 limit with $5,000 of debt. So to anyone else looking, wow, this guy's in trouble. He's maxing out his credit card. He's in trouble. And so that's where we get a little bit, customer can get themselves in a little bit of danger there from an optics perspective. They may have been able to write the check for $5,000, no problem. They just thought they were taking advantage of a great offer from Home Depot, right? And so what the banks are really looking for is a sub 35% on your debt to your credit ratio. So think of a $10,000 credit card. They don't want to see you with more than $3,500 in current debt, okay? That's at an aggregate level. You can have 1 or 2 cards, which is a little bit above, but again, they don't want to see that you're maxing anything out, okay? Right? Banks they're not stupid. Right? They go, all of a sudden he's got 4 cards and they're all at 60, 70%. Or this guy's living on the edge. Maybe they're probably not going to want to extend you a whole lot of credit. Versus the guy who comes in, this guy's got 5 credit cards. He's got a little bit here and a little bit there, but nothing material, right? He's using his credit cards that's normal. Okay. So when you talk to someone and they say, hey, I've got this credit card. I was thinking about shutting it down. I just don't really use it. We're like, whoa, never shut a good credit card down, because let's go back to that $10,000 example. If you've got $10,000 and you a $10,000 credit card and there's $5,000 balance, that's 50% debt to credit ratio. But if you take that $10,000 and you increase it to $20,000, well, all of a sudden you're only at 25% utilization. Okay, so that utilization numbers is a funny one, right? You want to make sure that you're not maxing out your credit cards.
Now, what if somebody comes into you guys and they are a little heavy? They're at 37, they're at 38, they're at 40%. They got that Home Depot for 5,000, but then the rest of their credit cards, have 5% utilization. Do you give them guidance, send them on the way? What happens in those type of scenarios?
Yeah, so we're going to have a very open conversation. A lot of what we do is we educate the customer and explain this, and they're like, oh, they don't know, right? Because it's not like we went through high school or college and learned about credit.
Right.
It's really kind of sad. Like, it really should be like a high school subject, right? Responsible use of credit. How a credit score, right? Common sense. What are we doing there? So what we say is like, look, we explain it to them. We explain what we're looking for. And we say, look, this Home Depot card, you've got to pay this down by, let's say, and it's all formula based for us. The algorithm will do it, right? So it's not a human calculating this, right? They go, you have to pay this card down by $2,838. And are you able to do it? And the guy's like, well, yeah, I guess if I had to, yes. I mean, all right, here's what you're going to do. You're going to pay that card down by $2,638. Then we're going to get on the phone with you. We'll get on the phone to Home Depot Finance, and we'll get a letter of the balance, of the new balance, sent over. So it's got your name, it's got your account number, the balance, a couple of other little details. And we will submit that to the credit bureaus, and we will actually get that updated within 24 to 48 hours. You see, if you pay off your credit card today, Ty, when will it update with the credit bureaus?
It's going to take 30 to 60, 30 to 60 days at least. Depending on the reporting cycle, it could take even longer if they report quarterly.
And some just don't report well. They're sloppy. They're not in a rush to do it, right? But best be sure if you don't pay, they'll report that.
Yeah.
So we'll take anyone, once you've made your payments, we will actually get that reported and reflected on the credit bureau, literally same day, next day, right? Just depends on the time of day it comes in. Right? If you come in at 9 a.m., we'll get you done the next day. If you come in at 4 p.m., it's going to take 2 days. Make sense?
Yeah, absolutely.
Yeah, and it's all about helping the customer. It's this education process, right? We're doing the job that the high schools should be doing.
Sure. So even if they don't meet exactly what we're talking about, and they're close, we don't want some 450, 580. They're just too far away. But if somebody's got something here or there, you help with them, the education and what they need to do to get to that level.
Exactly.
One of the other things you'd mentioned was multiple bank approvals. Now, I find this interesting because this is something we talk about all the time. Look, you're better off to get money from multiple sources than one, because it's going to be a lot easier to do so because it's less risk to those than the one. But what I think is interesting about that is that from a credit card perspective, what I've seen personally, right, is that like when my primary card bumps my limit up, then all the rest of the guys come right behind him and they start bumping my limit up. So do you give these business owners an advantage because you're getting them multiple approvals? And is it the same in the business space where you then start to see a lot of those lenders in due time mimic each other's approvals, and it makes it easier for them people in time to get their limits raised?
Yeah, look, the reality is banks, the way underwriting works with banks is one of the key contributors is how you've received, used, and paid back previous credit, right? So if, let's say you have a $10,000 credit card and we go and place another application with the right bank who likes your geography, they like your income level, they like your industry. That's really important, right? We can then go ahead, they'll go ahead and go, well, bank number one gave you $10,000, we'll give you 30% above that. So we'll give you $13,000, right? And then the other thing that we do is we actually train our clients and we teach them is, hey, if you use this money responsibly for 6 months, and you go back to the same lender, you can actually apply for and receive an increase in the credit limit, usually 30 to 50%. So let's say you got $10,000 approved today, use it, repay it, like obviously manage your money well, right? Fast forward 6 months, that $10,000 can get bumped up to a $13,000 or even $15,000 limit. And we're not going to charge for that, right? That's just part of our service.
That's awesome. Well, one of the other things that I think people are interested in with credit cards is rates. So on these kind of, whether did they go to a standard rate after 0%? And if so, what kind of rates are there on typical business credit cards compared to consumer?
Yeah, so rates, great question. So you're going to be 0%. We say for an average of 12 months. But here's the reality. We've got one or two banks at 9 months, the vast majority at 12. We have some at 14, 15 months, even going out as far as 21 months at 0%. Now, question, what happens after that 0% period is up? So here's a great one, right? What most people don't realize is a lot of store credit cards, let's say they give you a 12-month 0% period to buy some stuff from their store. If you are carrying a balance at the end of that 12 months, they will actually charge you interest for the entire 12 months prior. It's a little sneaky clause in there, right? And we don't like that. Right now, for some people, they need it and they use it, but the customer doesn't usually understand that till it's too late. All the banks we work with don't put those little hidden fees in. So let's say you took a $10,000 credit card, you paid it off, and at the end of 12 months, you've got $1,000 left. You will now pay $1,000. You'll pay interest on the $1,000, not the entire $10,000. Does that make sense?
Sure.
Much more fair, right? So the rates are going to be anywhere from 9, usually 11, 12% now. The rates have kind of gone up. 11% at the low end, going up to like 27% at the high end. We're seeing the average with our clients, because we work with good credit profile folks, we're seeing an average of around 15%. The way we explain it, we're like, look, year one, if you want to keep the money for 2 years, first year you're going to be at 0%. Second year, you're going to be at 15%. So 0 year one, 15 year two, blended average 7.5%. Pretty darn good.
You know, I'm a business credit guy, and I believe in short-term financing, getting people what they can get, and then helping them with the better rates and the no PGs down the future. Does what you guys do help in that world of building business credit, building commercial credit for the EIN that's not linked to the social?
Yeah, absolutely. So some of the credit cards, business credit cards, standard credit cards, they're different, right? But business credit cards, the majority of them will actually report to their business credit profile. So it will actually, as long as they make payments, right? It will actually help them build their business credit. So down the road, they're going to be able to open more doors to them, whether it be a more traditional line of credit from a bank, or whether it be a term loan, equipment financing, etc. So not only will it open the door, but will actually also, as you know, will give them much better rates in the future as well. It all comes back to, hey, have you received money? Have you used it? And have you paid it back? Have you been responsible? And if you can prove that, and that's what a credit score is, whether it be a personal credit score or a business credit score, if you can show that you've been responsible, that's where the doors really open up for you.
With SBA loans, you know, well, the nice thing is that people can just roll their fees right into the loan. And, you know, the other nice thing about some financing is they don't have upfront fees, but a lot of it does. You know, they charge points up front. They charge application fees. What's it like with you guys? Is it possible for somebody to get in without money out of pocket up front? And is it possible, like in SBA, to roll in whatever fees may be associated into the actual deal?
Yeah, so a very important question, right? So one of the most important things that we look for is, can we keep that customer's debt to credit ratio down, right? The last thing we would want to do is go and charge that customer a whole bunch of money. They say, oh, I have to put it on a credit card because I don't have it in my checking account, right? But then that would ruin or inhibit our ability to get them funding. So we kind of take a different approach. We say, hey, we're going to put our money where our mouth is. We're going to do all the work up front. So we'll collect all your documents, process your file, review your credit, etc. We'll go to the banks. We'll submit the applications, handle all that work on your behalf, and we don't charge anything up front. Our fees all come once you've actually received the money. So Ty, if you were our customer, once you get your $50,000, we would then send you an invoice, and then you would pay that online. Knowing you're probably going to jump on your laptop late at night and handle that invoice late at night. Okay. Some of our clients want to speak to us over the phone and do it over the phone, and others just like to do it late at night on their phone or on their computer.
That's awesome. So the benefits of the SBA loan without any of the upfront fees, those type of things. Okay, so let's say somebody's interested. I mean, obviously, why wouldn't you be? You're building business credit. You're getting 0% rates. You're getting up to $150,000 as a startup. You're getting it through credit lines or credit cards. The benefits of 0% with credit line capability and cash out, right? So what's the process look like to come in with you, to inquire, to see? There's no hard credit pull, so we know that. What's the process look like and the time frame from initial inquiry to funding?
So we can actually have people taken care of same day if they want. Now, they're not going to receive the actual money same day, right? Sometimes that's going to take a little bit longer because let's say the bank gives an approval, but then they need to go and print that credit card, put it in an envelope with all the materials and the checks and whatnot, and then they're going to ship it to you via US Postal Service. And so now we're at the mercy of the US Postal Service. Our average time frame is 2 to 3 weeks. Our more motivated to get money in hand, our more motivated clients are going to be in that 2-week mark, right? And it really just depends. Like, for example, we just had a public holiday. That's always going to slow things down by a couple of days.
Makes sense. What about the future? Can somebody come back then after they come back to you for the first round? Can they come back at any time in the future to possibly get some more funding?
Yeah, definitely. The short answer is yeah, we can always do that. We have a few clients who we've done that for. We get a lot of referral-based business like that. So that they may say, oh, you got me $100,000. How much more could you get me? And we say, well, we could probably get you another 40 or 50. And they go, okay, but I want another 100. We say, okay, well, do you have a business partner or a spouse, etc.? Yes. So they'll bring their business partner and they'll get another 100,000. We actually had one about 3 months ago now. I'll never forget it. One guy came in. We approved him for, I think, around $70,000. Within 2 weeks, we had his there's 4 partners in total. Yeah, 4 partners in total. We got them combined $470,000.
Wow.
$472,100 to be exact.
And these are probably the same people that had no chance of going in and getting any kind of loan from their bank.
Yeah, they've been running their business for like 4 months, growing pretty quickly. Started with all their own savings and they wanted to keep growing, but they were tapped out. Just the cash flow was killing them, making payroll. They'd rented a space, they wanted to rent a bigger space, and they just needed the money. And so we were able to get that for them in a couple of weeks. They had a great experience with one partner. He brought his business partners in, and yeah, $472,100 all in.
You know, Roy, there's not a lot of people in this space that do anything or close to what you do, and nobody is reputable is what I found. And I can go on and on about why I think you guys are the best, but what do you think? I mean, what makes you guys the best at what you do in this space?
From a customer's perspective, we really take a simple approach, right? Different companies will say, oh, customer first. And we actually don't take that approach. Our approach as a business is it's staff first. We believe that if we look after our staff, so first, we hire great people. Second, we provide fantastic training, an obsessive nature about training. And we treat them really well. And we know that if we treat our staff well, they're going to treat our clients well, right? It's going to be kind of hard to treat your staff pretty miserably and then expect them to provide amazing service to their clients, right? So the way we kind of talk about, hey, we want you to treat every single customer as if it's your mum's best friend, okay? And just provide that amazing service. So that really starts everything, is providing amazing service. Next is we have an acute obsession about every single metric and data point and how can we improve them. Every single team meeting, every single management meeting, every sales meeting, every funding team meeting, every single meeting, we have all our stats measured in real time. So if you walk through the office, you're going to see tons and tons of TVs with just data rotating on the screens. Everyone has access on their computer. Everyone has it on their smartphones. Some people get a little obsessed. We have to take away their access on their phone, right? They're like, come on, you could go without it for 10 minutes, right? But it's that obsession of how can we be better? How can we deliver better service, right? And that is really where we feel that it separates us from everyone else, is because we measure it, we know where we are, we're honest with ourselves, and what can we do to improve it?
You know, and when we introduce this program, there's always some crazy Yahoo that literally thinks that they can go out, because we mentioned cards, and that they can go out and do this on their own, right? And we helped somebody do that because he didn't want to pay a fee, and he got 12.5, and we had him approved for 75. So he missed all that funding he could have got. But what do you see? I mean, I'm hearing 0%. I'm hearing credit line capability. I'm hearing multiple approvals. I'm hearing business credit building. None of these things are things that I even know of that an average layperson can go out and do on their own successfully. But what do you say to that person? Because you have to deal with that same objection that we deal with as well.
Yeah, I'd say we deal with it probably 20, 30%, maybe 10 to 20% of our customers kind of throw that comment out there. And the short answer is we say, look, you can. In theory, you could go online and apply for credit cards, right? There's nothing stopping you, right? The problem is you don't know which credit cards to apply for. And what we've seen, and this is the worst thing, I wish I could somehow have like a time machine to change this, is someone says, I'm going to go do it myself. They go out, they place a whole bunch of applications, they get declined, or they get really small approvals, or they get approved for the wrong cards, right? And then they come back to us and go, I tried it, didn't work, can you help me now?
Yep.
And unfortunately, we can't, because they've already kind of ruined their credit and they've ruined relationships with the banks because they didn't know how to position their application, right? I'm not saying go ahead and lie or anything like that, but you need to understand how to structure and format the application the way the bank wants it.
Right.
And that's as simple as that, right? I recently looked into the mortgage space, got a mortgage, all that good fun stuff, right? And I used a broker, and not cheap, right? But I know for a fact there is no way in hell I would have gotten that mortgage approval without him, right? And his firm. The stuff that they were asking me to submit, the forms, the way they were asking me to change my email responses to use the correct verbiage that they knew the banks were looking for.
Sure.
There's no way I would have gotten that mortgage without him. And we're exactly the same, right? So short answer, can someone do it? Yeah, they can go and take a crack at it. But the gamble is just so big because if they kill it, that's it, they're done, right? They kill their credit profile, they kill the relationships with the banks. They're locked out for the next 12 to 18 months. And we get those, and we wish we had like a time machine. We could go back and change it.
And we do too, and see the same thing. People come in with a fraction of the approval that they could have got. They got cards that didn't help them build business credit. They're paying interest rates when they could have got 0% financing. And when you look at the substantial cost that it was, then they pay sometimes 5, 10x of what they could have coming in and getting the better result.
The worst is they don't get the money, so they can't grow their business. Put fees aside, even they're paying interest rate. If they just can't get the money, that one is the worst one because we knew we could have helped him, but he chose to do something foolish, and we can't help him now, and no one can. And that one, it kind of breaks my heart to see it sometimes.
Yeah, and what's nice about you guys is there's no hard inquiry on the credit report. There's no cost. So it costs nothing for somebody just to come to you and say, hey, what can you do? And same day, you're able to tell them, here's exactly what we can do. So if they're doing that, then you're giving them a preliminary pre-approval that kind of gives them that range of what you can do for them. And it happens pretty quick, right, at no cost to them.
Yeah, we'll turn that around. At the end, we'll have a conversation with them, 10-minute conversation, and then we'll give them a real-time answer, right? So then, if they're pre-approved, we'll then have a senior funding advisor get on the phone, walk them through their options. And we really want to educate our clients. So we're going to walk them through how they get the money, how they use it, how the payback works, what are the fees. We don't want those nasty surprises, right? So what I was talking about, some of those retail stores that if you don't pay it off after 12 months, those store credit cards, that the interest goes back all the way to day one, right? We don't want that stuff. And so we're going to spend that time educating our customer. We're not just going to send them 50 grand and go, you're on your own, good luck. Right? We want them to know what they've received, how to utilize it, and how to ensure that they're keeping the fees the lowest. We don't want them paying cash advance fees. If they didn't follow our instructions and they pulled money out of that card, they'd be paying 25, 27% versus 0%, right? Probably worthwhile having a 20-minute conversation with us, I think.
Yeah. Any parting thoughts as we get ready to wrap up?
Yeah, I mean, look, we're at the forefront of businesses in America, right? And it's one of the greatest things is we get to see all the new industries and what's going on and speak to excited entrepreneurs every day. We get to see the food truck revolution. We got to see the escape room revolution, which I love those. We got to see the sheer volume of applications coming through the e-cig business, the medical marijuana or recreational marijuana. And so we get to see all these different entrepreneurs. And one of the things that I would always share with every single entrepreneur is, hey, find something you're excited about and go for it. Be smart, crunch your numbers, have a plan, right? But not every business needs money, but if you do need money to grow your business, right? Hey, we obviously pretty impartial, we're pretty biased over here. We feel like our source of money is pretty darn good for a startup business, but be smart with it, right? Don't be foolish. And always take more than this sounds kind of counterintuitive, but always take more money than what you actually need if it's available. So let's say you've done all your numbers and you go, okay, I need $30,000. We would always say, don't take $30,000. If you can take 50, take 50. And the reason being is, hey, life looks amazing on a spreadsheet. You put all your business plan together on a spreadsheet and it looks great. What happens if something changes, right? You need to hire another person. Here's a simple one, right? You hire a guy, he's not doing a good job. You need to hire another person, right? But for a little while, you're going to have 2 people. If you didn't budget for that and you only took that $30,000, you're going to be stuck. So by having enough money prevents you from, if you have enough money, you're not going to have to make short-term poor decisions, right? when you're restricted on money, you make poor decisions because you have no other choice. And you know you're making a bad decision, but that's your options. When you have enough money, you can make good choices. You have more options available to you.
And all the science and all the studies support that that's what causes business failure as well, is not having access to that capital. Roy, where can everybody go to start this process with you to inquire to see how much they may be able to get approved for?
Yeah, jump on seekcapital.com, SEEK, capital, CAPITAL.com. Just follow the prompts, answer a couple of questions. We'll call you back in a couple of minutes. We're pretty darn quick.
I appreciate you taking the time to join us today.
My pleasure. And Ty, sincerely, thank you for having me. Love your whiteboard. Love the blackboard in the back there.
I appreciate it. I wish I could take credit for it, but I have somebody that actually is much better at art. So listen, everybody, remember, this doesn't mean anything unless you do something about it. So seekcapital.com is the place to go, seekcapital.com. I'm going to put this on the show resources page and a link to Roy's LinkedIn page as well. Look, guys, we work with over 1,000 lenders here at Credit Suite, and I can tell you that you are hearing from the leader of one of the best that we have ever worked with, by far the best in the startup space. They are innovating in a space that lenders are afraid to get into, and they're giving a shot for entrepreneurs that don't have a shot elsewhere. And the ones that can get financing elsewhere, they're making it easier and cheaper to get money through them than most of the other sources that you're ever going to find. So if you want the best, if you want the most amount of money and the best terms, then this is definitely worth your time to go check out. Go to seekcapital.com. It doesn't cost you an inquiry. You know the qualification requirements. We've went through, I think, pretty much everything you need to know. And those of you listening, watching, you know, I'm not one to do this at the end of a show, but this is something I really believe in because, I don't know, it has to be millions that our clients have got in funding from Seek. The process is seamless. Their team is phenomenal. It's just been such an amazing experience. So make sure you check out seekcapital.com to either talk to them more about offering this for your customers or for you getting it for yourself. So remember, everybody, visit seekcapital.com. Thanks, everybody. Have a great day.